Hey, everybody, we're here with Dave Bliesmer, True Rate Mortgage Group. And Dave is one of our experts with a program that allows you to buy a home before selling your current home. Dave, is it really possible to do this? I mean, you've heard about this in the past. It used to be called like a bridge loan. What are people doing today to buy a new home before selling their current home?
Yeah, it's a great question. And there's a few different variations of it, to be honest with you. So, there's ways to basically leverage the equity in your existing home that you're preparing to sell and advance that equity to be used as your future down payment on the next property. And then at the same time, basically omitting that obligation because you've got a guaranteed buyer on the sale of that home. So that's one option to navigate. The other option is we can absolutely go through programs too, where there's just an LLC cash buyer on the front side, and they physically purchase that future home as cash, and then basically resell it back to the client once they've sold their departing residence. So there's two kind of different paths that people can take with those.
Um, Everybody's wondering, great, that sounds really cool. Sounds too good to be true. But the question I always get, and I'm sure you do too, is, well, that's fine, but what are the costs with these programs? Which program are you using, and what does it truly cost to essentially use money from somebody else to get that home before you sell your current house?
Yeah, it's a great question. Again, it depends on the program and the variations of that program, but generally speaking, if you're going to look to, leverage the equity out of the existing home, almost like you would with a traditional bridge loan, typically you're going to be looking at paying back, 2.4 to 2.5% of the sales price of that home as the fee for that transaction, which, at first glance, people might think, well, that's an awful lot of money to take out a bridge loan, where in reality, it's really not, because if you look at a traditional bridge loan, usually you're going to pay 1 to 2% of the loan amount just for an origination fee. And then on top of that, you'd have your appraisal fees, your deferred interest, et cetera. So really doing the math dollar for dollar, that 2.4% number really kind of works out to be very similar to what a traditional bridge loan would be. The big advantage with that particular bridge option is we're able to omit the obligation of that home because we've also got a guaranteed buyer for that property. Like, the home is basically going to be guaranteed to sold with no contingencies. So that's the huge upside with that one. On the future property, that one's a little bit different. Typically, that fee is going to be closer to 1.9% of the purchase price of the future home, but you don't pay that back to the cash buyer until you've actually sold your departing residence, and now you're purchasing that home back for them for the same exact dollar amount, paying them that 1.9%. And then in addition to the 1.9%, they'll collect deferred rent because they'll let you occupy that property as soon as they buy it. So as soon as they close on that purchase, you can move out of your existing home, move into the future home, and then you pay that 1.9% plus the deferred occupancy costs. All of that is paid from the sale proceeds of your existing home once you've closed on that sale. So,
What if you
you're
can't
basically
sell?
pulling that money from one transaction and just funneling it right into the next one.
You may have explained it, but what if you do the program and then your home doesn't sell?
Either scenario, you typically have a 4 to 6 month window to get that home
4 to 6
sold.
months to sell your house.
That's correct. Yeah. So
Gotcha.
you definitely want to have a very sound listing strategy. And, regardless with either of those options or programs, those groups who are providing either the bridge loan or the LLC that's going to be looking at the purchase, they're going to go through a listing strategy with the client and their realtor. So they've got very detailed benchmarks on where they're going to potentially get more aggressive on the sales price and so on and so forth. So yeah, it's a very calculated listing strategy when either of those programs are used.
And when you're vetting a borrower who's interested in this, you obviously go over this and then you tie your strategy in with the realtor and, hey, what's our long-term plan? We've got to get this thing sold in 4 months. Here's our cost. And at the end of the day, it either makes sense or it doesn't. What are the eligibility requirements? Are they different than a standard loan? I mean, Tell me a little bit about that.
They're not necessarily different than the standard loan, but the key element is we've got to have a fully underwritten, confirmed loan approval for the future purchase before either of those options would be approved. Because obviously, the reason that's the critical piece is whether it's a cash buyer buying the future home or whether it's a institution doing the bridge option on the existing home. Obviously, the largest concern is what is the qualification parameter for them on this future purchase. So because we have to do that full underwrite and verify employment, income, asset, et cetera, it's usually a very sound transaction on both sides. And where people kind of get nervous with it at first is when you think about selling that existing home in a 4 to 6 month window. Sometimes that can be overwhelming to think about, but obviously if you've got, a really good realtor on your side and there's a very sound listing strategy with that existing home, more often than not, we're typically seeing those properties sell well before those deadlines in that 4 to 6 month window. Yeah, so it's a great question.
Who is this program not for, in your experience?
Yeah, that's a great question. I would say it's probably not a program for somebody that needs to squeeze every single penny out of the sale of their existing
Somebody willing to
home.
give up a little bit.
Yeah, so if you're a first-time buyer, maybe say you've got like 3 or 5% equity in that home. Yeah, I mean you're really cutting it tight on leveraging that limited amount of equity. So I think it's definitely going to be for the people that have a noticeable amount of equity in that existing home. I think my general rule of thumb would be, you probably want to have close to 10% or higher of equity in the home before you entertain any of those options, quite frankly. And then, you also have to, be somewhat risk adverse, right? Because even if you take care of, getting your qualifications done, getting your listing strategy done, et cetera, if you go out and buy that future home, you're still on the bridge option responsible for your current first mortgage on your property plus that future first mortgage. Whereas if you do the cash buyer option, the cash buyer physically bought that home. You have no payment obligation on that property until you actually close on your sale. And then you're buying that home back from the cash buyer. So the bridge option too is going to be for somebody who's a little bit more sound-minded in balancing their own budget, because if you do have multiple mortgage obligations during that period of time, that can be an overwhelming thing for certain people to budget. But then again, in those scenarios, I would say probably look at the cash buyer option, because then it eliminates the need to have those multiple mortgage obligations. And then the last thing I would say too, just to, give peace of mind to this, if a consumer goes through either of those processes, right, to get approved and qualified for either one, they don't necessarily have to go through with it. So even though you're qualified, it's very similar to getting qualified for a mortgage, right? Even if you go through the process to get approved, you're not actually going to do the transaction until you've either taken that bridge loan out on the existing home or, the cash buyer has purchased that future home. Once those events take place, then you're absolutely engaged in the transaction. But at any point in time up to that point, you're not necessarily obligated.
So 2 really good options, Dave. And the first step one is just to talk to an expert, talk to a specialist, put down the plan, see if it makes sense, go over the net numbers, what kind of money you're going to walk away, what you're going to need, and then also tie the realtor selling plan in as well. Those are great options, Dave.
100%, yeah.
We're going to leave your number on the screen here for people to contact for questions on the program. And any final thoughts on that?
No, I just think it's a really nice solution because, the other alternative is you either do the old-fashioned contingent sale, which is tough this day and age, with a lot of us that have kids, pets, et cetera. That's always a challenge in itself. Or the other option would be if you just had, tons of money where you could just go out and, fund your own down payment on the future home. So again, there are situations where people don't need those programs, but I do think they're definitely gaining more popularity because it adds a ton more convenience to a family that's trying to buy and sell simultaneously.
Dave Bliesmer, always appreciate you. Have a great day. Mortgage Ballers, Dave Bliesmer, reach out if you have a home and you're in a situation you want to buy a new home before selling the current one. talk about the options. The more you know, the more you go. That's it.